This is the study session on financial reporting and analysis and the reading on understanding cash flow statements. Let me give you a few of my thoughts here before we get into the slide deck. Remember what we've done in the last two videos. We talked about the income statement, we talked about the balance sheet, and remember that the accounting regulatory bodies have lots to say about what goes on and how we value those financial statements. And so what we're doing in this one is trying to dive into the cash flow statement so that we as financial analysts can use the financial reports that the accountants provide for us to give us some extra information about the value of a company. And so in the big picture sense of the cash flow statement, what we're trying to do is to figure out how profitability and total asset value on those two previous financial statements, how do they relate to generating cash flow? I bet many of you remember from your undergraduate accounting days that in your very first finance class, the textbook in chapter 1 said something like cash is king. And so that's really what we're trying to do in this reading. So let's get right to the LOS, compare cash flows from operating, investing, and financing. Okay, so this is what we're doing. The companies have three sources of cash flow. Primarily, these cash flows are generated by the assets and the product lines of the business. We call these operating cash flows. But then, of course, we spent lots of time in the corporate finance reading talking about investing in positive net present value projects. And so those are examples of investing activities. And then financing activities have almost everything to do with a bond issue. And so notice I have some examples there in each column. So operating activities, inventory sales, receivables, fees. Investing activities, there's the investment in positive net present value projects, PP&E. There's intangible assets. And then financing activities, there are the bond issues and repurchasing stock and repaying bonds. How about non-cash investing and financing activities? How do they affect our life as financial analysts? And those of you who have followed these videos will know I've told this story before. As an undergraduate student, I remember sitting in my first accounting class and the professor kept saying depreciation is a non-cash expense, and I kept thinking to myself, why do I care about it if it's non-cash? And it finally dawned on me that there are cash flow implications, of course. And so let's go ahead and look at these non-cash transactions. Any transaction that does not involve an inflow or an outflow of cash. And here's a list of some examples. Issuance of stock to retire debt. Purchase an asset by issuing stock, bonds, or a note payable. Boy, that occurs many times in the merger and acquisition game. Exchange of non-cash assets. This happens when companies use their own stock to buy an asset from another company. How about the two conversions? We spent some time talking about convertible preferred stock and convertible bonds, exchanging one non-monetary asset for another one, and then issuing common shares for dividend purposes. So here's really the important part. Notice that non-cash transactions can significantly affect lots of things, but especially a company's capital composition. So how do we deal with these kind of things? If they are non-cash, they're not going to show up, just magically show up on a balance sheet or an income statement. But what they will do is they'll show up somewhere else, and then they're going to be disclosed as notes to the financial statements. All right, here's an example for Nike. Down at the bottom, underneath in the cash flow statement, there's a non-cash addition to property, plant, and equipment. What does that number say? 294. All right, this is an important LOS. Contrast cash flow statements prepared under the international standard versus the U.S. standard. All right, so let's take a big picture look at each of these accounts. So what are we doing down on the left-hand column? We're doing interest, both received and paid, dividends, both received and paid, and then some income tax and overdraft items. All right, so here, you're just going to have to memorize this. Let's go ahead and start on the right-hand column and identify whether these are operating or financing activities. So interest received and interest paid, these are both under US GAAP part of the operating activities because the US Accounting Standards Board looks at issuing a bond and paying interest or receiving interest because you've made an installment loan or something as just part of regular operating activities. Same thing with dividends received because we're investing in another company and we receive those dividends. Dividends paid, however, that's a financing activity. Income tax is operating activity, and then the bank overdraft, that's financing. That has everything to do with, interest on a loan or a bank loan. But an overdraft, that's really a minor issue. Now, over in the middle column on the international side, and so notice those first four, the International Financial Reporting Standard indicates that the interest paid or received, dividends paid or received, can be recorded either as an operating or an investing activity. And then for income tax, this is pretty similar to US GAAP, but a portion of it has to be allocated differently to either investing or financing, depending on how it's identified. And so, the activity can be pretty much identified as either investing or financing. And then the overdraft is just part of the cash. Now, we can do this. We can report these either through what's known as the direct method or the indirect method, and I have some good examples as we get through the slide deck here. But US GAAP and the International Financial Reporting Standards both allow direct or indirect methods. Although preferably, both of them want you to use the direct method. But the distinguishing feature of the US standard is that there has to be a reconciliation of net income to cash flow, and that has to be provided regardless of whether you use the direct or indirect method. How about this one here? Describe arguments in favor of direct and indirect methods. So the direct method is exactly what you might think the name suggests. Each cash inflow, each cash outflow that's related to the cash coming in or the cash coming out, whether it's a receipt or a payment, is shown. What that does is it eliminates the impact of accruals. And so the argument in favor of this is that what it does is it provides this extra information on the specific sources and uses of cash. The indirect method, however, starts with net income and then makes adjustments indirectly. So it starts with net income and then makes adjustments indirectly to get to that final cash flow balance. And the arguments in favor of this one includes illustrating the differences between net income and operating cash flow. And regardless of what your personal preference is, or whether you prefer calculating or viewing this in the direct or indirect method, you should at least appreciate this as a financial analyst, because remember, the net income can be almost anything. According to, internationally and US accepted accounting principles, it could be almost any number. But cash is king. Cash flow is cash flow. It doesn't make any sense if we're trying to evaluate a company and the company has, let's say, $1 billion in net income and has $0 in cash flow. It doesn't make any sense to say, oh, well, those things are the same number. They're the same account. They tell us similar kinds of things. No. We need to reconcile those two. All right, how about cash flow statement being linked to the two important financial statements? And so here's really a simple formula. You start with the beginning balance, and then you add the cash receipts from all three of the activities, and then you subtract the cash payments from all three activities, and that gives you the ending cash balance. Now, here are some important bullet points. Differences between the accrual basis and the cash basis on the balance sheet is represented by the operating activities on the cash flow statement, and that's the cash part of those operating activities. The investing activities usually shows up on the long-term assets, of course, investing in positive net present value projects. And then financing activities, this is what I said earlier. I always think of it in terms of debt or bond issue, but of course it can be part of equity. And those are on the right-hand side of the balance sheet. Now here's a description of Nike's 2018 from their financial statements. Notice on the right-hand column, there's the consolidated statement of cash flow. And notice at the top, there's net income. And then there's depreciation. And there's a bunch of other operating stuff. And then there's some investing stuff. And then there's some financing stuff. And all the way at the bottom, you get that cash and cash equivalents. And that's the number that appears over on the balance sheet. So what you can think of, those consolidated statements of cash flow, is kind of like a sub current asset account. Describe steps in the preparation of direct and indirect cash flow statements. All right, so this is what we're going to do. We're going to put together the operating activities, followed by investing activities, followed by the financing activities. So under the direct method, what we're doing, as we said earlier, we're going to determine cash received from customers, determine cash paid to suppliers and other stakeholders like employees. So we have cash coming in, cash going out from operating activities, and then some other stuff as well. Under the indirect method, what we're going to do is we're going to start with net income and then adjust it for some non-operating activities, non-cash expenses, and then changes in working capital. Now, of course, it shouldn't matter whether you use direct or indirect. The cash flow is going to be identical. How about we look at this LOS? So we've been talking about the difference between the two. And if we go back to that one slide under US GAAP, where there has to be that extra information about reconciling cash flows. So let's go ahead and convert cash flows from indirect to direct. All right, so this is what we're going to do, three-step process. We're going to start with net income, and we're going to disaggregate into the revenues and the expenses. So think about starting at the bottom of the income statement and then working your way up. You have the expenses on the left, you got the revenues way at the top right. So we're disaggregating those two. Then the non-operating and the non-cash items are removed from the aggregate revenues and expenses. And then the accrual amounts of revenues and expenses are converted to cash flow. And then, of course, don't forget changes in working capital accounts. So here's a quick example. We have a company, U.S. company, follows GAAP, reported net income $500,000. So let's calculate cash flow from operations using the indirect method. So what we're going to do is start with net income. There's that $500,000. So we're going to add depreciation of $100, and then the gain on the sale of land. Remember now, that's going to show up. That's going to show up on the income statement as one of those, like a discontinued operations. So we're going to have to. So we added it to get net income. So we're going to have to subtract that. Interest expense, we're going to ignore that. Increases in plant, we're going to ignore that. And then we have these short-term assets and short-term liabilities. This is the working capital stuff. So we have, what do we have here? We have an increase in accounts receivable, decrease in inventory, increase in wages, and increase in taxes payable. So really, this is just an adding and subtracting LOS, convert those cash flows, but we need to make sure we have the plus sign and the minus sign in the proper order. And so here's the answer. So we start with net income. There we add the depreciation expense, subtract the gain on the sale. We have an increase in accounts receivable, so that's a subtraction. We have a decrease in inventory, so that's an addition. All right, so that's on the left-hand side of the current, on the balance sheet under current assets. So we switch over to the right-hand side under current liabilities. And since we had an increase in both wages and taxes payable, we add those. And so if you do the math there, you get 575. How about analyzing and interpreting both reported and common size cash flow statements? All right, so this is really a critical LOS, because as financial analysts, what we're trying to do is determine how to reconcile net income with cash, right? Net income with cash. And then when we have this cash flow, we need to figure out, where's it coming from? I mean, where do we want most of our cash flow coming from? We talked about this in the income statement video. We want to make something for pennies and sell it for dollars. And so successful businesses, those that have sustainable and higher growth rates in both, dividends and cash flow, those are the firms that generate lots of cash flow from operations. All right, so we have a couple of different ways to do this. Let's start with A, the evaluation of the major sources and uses of cash flow. And so depending on the growth stage, that's what I just mentioned, those major sources are going to vary. Company must generate cash flow from operations to remain in business. That's what I was talking about with the sustainable. Is preferable for a business to use cash in investing activities where such opportunities exist. And so what's the deal here? What we want to do when we find positive net present value projects, we'd love just to have tons and tons of cash laying around. But remember, these capital budgeting projects are often, hundreds of millions, if not tens of billions of dollars. And so firms, they like to use up their cash, but they don't want to use all their cash. And that's why firms issue debt and equity. And so the cash flow from operating activities must be sufficient to meet those capital expenditures. Now, let me say something here as well. Remember that large corporations like Nike and Procter & Gamble, they issue lots and lots of commercial paper. And that commercial paper, what that does is that stems, the spikes and the troughs in the cash flow, because these companies still have to make payments every day. So they rely on that commercial paper. All right, how about part B, evaluating the primary determinants of operating cash flow? Let's look at changes in working capital so that we can make a determination if that cash from operations is coming from working capital. So what is that working capital? Those are things like, let's just take two of them. Accounts receivable on the left-hand side of the balance sheet, accounts payable, right? So what tends to happen there? That's to make something for pennies and sell it for dollars, but that's the part of it that says something like, well, we're not paying for this and we're not receiving cash for our revenues just yet. So that working capital, reliance on working capital, goes a long way to determine the magnitude of the cash flow. Now, there are lots of readings in level 1, level 2, and level 3 that have great discussions on this thing called earnings quality. What do we like about earnings? We want earnings to be, we want them to be high, first of all, right? We want them to be stable, and we want them to be relatively predictable, not perfectly predictable, because we want our executives to take lots of risk. But so we want these earnings, we want high earnings quality, and that's one of our jobs as financial analysts, is to compare and contrast different qualities of earnings between and among different companies to try to find which one is best for each of our clients. And then a part of that earnings quality is the standard deviation of earnings. So variation in earnings and cash flow should be examined. Of course, this has so much to do with the risk profile and the ability to forecast those future cash flows. I mean, for example, take Milton Hershey and the Hershey Company. If as a financial analyst, you knew that Milton Hershey was going to wake up every day and just make Hershey Kisses and Hershey chocolate bars and just do chocolate. Well, the standard deviation of those cash flows and those earnings is relatively low because of the brand name, et cetera, et cetera. But if one day Milton Hershey got up and said, you know what, I'd like to make golf carts today, or I want to make a new Rubik's Cube, or I want to make furniture, I want to do something else. Whoa, boy, that really changes the dynamic of the company's risk profile. Remember, operating cash flow, make something for pennies, sell it for dollars, in the cash generated from the product lines of the business. All right, how about primary determinants of the investing cash flow? So this is this is a measure of how much cash is being invested in property, plant, and equipment, positive net present value projects. And then whether or not we're investing in other companies, and then whether or not we sell our assets. How about determinants of financing cash flow? So this is the reliance on capital and repaying on capital, whether it's a bond issue or a bank loan or a bank overdraft in the simplest of all cases. Common size cash flow statements are prepared using 3 alternative approaches. Now remember what we did with the balance sheet, remember what we did with the income statement. The common size balance sheet, what we did is we took a percentage of the assets. Over on the income statement, we took a percentage of the revenues, and that made perfect sense. But here we can take a percentage of total inflows, we can take a percentage of total outflows, or we can take a percentage of revenues or even net revenues. And so what we're probably going to do is that when we have cash coming in, we'll take a percentage of those total inflows, and the same thing with cash going out. And what these common size cash flow statements can do is help us identify companies that have sufficient cash. I mean, what do we want? We want to invest in a company that has enough cash, has enough ability to generate cash so that when a positive net present value project comes along, that they can quickly issue a bond, they can quickly issue shares of stock, or they can use the cash available on hand. But it's important to remember that if there is a bond issue, then we need to generate cash flow today and tomorrow and 10 years from now so that we can repay the debt. Not only the interest expense on the debt that shows up every 6 months. Remember that coupon payments are paid for most companies every 6 months, but also that balloon payment at the end, which will probably be retired either with a series of maturity dates or with a sinking fund. All right, let's get into my favorite kinds of LOSs. They say calculate. All right, two kinds of cash flow. I bet you guys remember this. Free cash flow to the firm. So what I want you to do is think of this in terms of free cash flow to the entire firm. So here's the definition. It's the cash that is available to a company's suppliers of debt and equity capital after all that other stuff has been paid. So we've paid the operating expenses, we've made the required investments in fixed capital, and we've paid off working capital. All right, so there are 2 formulas there that you probably have to memorize. Start with net income, add some non-cash charges like depreciation, and then you have to consider the subsidy of the interest expense, take out capital expenditures, take out working capital expenditures. Now remember, those last 2, they could be positive. They don't have to be negative. Oh, look at the bottom formula as well before I move on to the next slide. You can start with operating cash flow. You know, most companies call this cash flow from operating activities or cash flow from operations. When I was in graduate school, I always learned it as operating cash flow. How about free cash flow to equity? So if I swing back here, the first measure of free cash flow is the cash flow that's available to the entire firm. Now we want to know what's available to just the shareholders. So this is the amount of cash remaining after all operating expenses, all borrowing costs, and all required investments in fixed and working capital are made. This is the cash flow available to the owners of the business. These are available to the common stockholders. And so all we need to do is start with that cash flow from operating activities and then take out the capital expenditures and then figure out whether you've issued a bond or retired a bond. Positive free cash flow to equity means that the company has more operating cash flow than it needs to cover capital expenditures and the repayment of debt. So what is that saying? That's a good thing. We want lots and lots of positive free cash flow to equity, which means that we're generating lots and lots of operating cash flow. And then we're using that cash flow to invest in positive net present value projects. We're going to repay some of our debt, but then we have some cash left over. Now, let me switch gears here just quickly and take a link back to a previous video. This is where firms get in trouble. When they have lots and lots of free cash flow to equity, there is the temptation to consume these with things like excess perks and bonuses and salaries and all that kind of stuff. So that's a great question. But remember now, the goal of the firm is to maximize shareholder wealth. How do we do that? Well, we generate lots of cash flow. So we want to generate lots of cash flow, but we need to be careful about it. How about some ratios? These are really simple ratios. I mean, look down on the left-hand column, cash flow, revenue to assets, equity to income. And so all we're going to do is take our cash from operations and divide by some other account on another financial statement. And so what we're trying to do in each of these is to figure out how much cash that we're generating from operations in relation to things like revenues on the income statement, total assets on the balance sheet, shareholders' equity on the balance sheet, or operating income in the middle of the income statement. And then a couple other per share things here: cash flow per share, debt repayment, dividend payment. And so these are ratios that are going to tell us how well we manage those cash payments to our shareholders. All right, so go back to that free cash flow to equity. That's the amount of cash we have after we've invested in all these positive net present value projects. What can we do with that cash flow? Well, we can pay the shareholders a dividend. We can pay the preferred shareholders a dividend, although that's not the choice at that point. But we can also repay a bond issue. And then here are some coverage ratios. So this is debt coverage, interest coverage. So this tells us how we're managing our capital structure. And that takes us through this reading. Up next, financial analysis techniques.